I believe the ongoing stock market crash has the potential for investors to make huge returns over time, potentially multi-generational wealth building opportunities. That said, most people will not be able to achieve that because they do not have what it takes to achieve it. And let me elaborate in this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is not financial advice. So let's understand, first of all, what's going on. So you have high inflation. Everyone sort of knows that. And you have the Federal Reserve cracking down on it, sort of saying, hey, unemployment's low, so we're going to tighten the economy. You're going to see higher unemployment. Here it is, an article from CNN saying, hey, you might see an additional 1 million unemployed. I honestly think that figure can be multiples higher if the Federal Reserve is indeed serious about breaking inflation, which they seem to be. Jerome Powell even saying, look, the housing market needs a difficult correction. That is going to have huge read through. I mean, if you're talking about a 20% plus decline in various different real estate markets, that has huge read throughs, not only for individuals, but for the banks as well, and for their own credit creation. So I asked investors, I said, hey, this is on my Twitter profile. You can check it out at Unrivaled Invest. I said, should investors ignore the Federal Reserve and the policies they pursue? Most people say, no way. A minority of the folks say absolutely. Should you ignore the Fed? And feel free to leave your comments below. I personally think the majority is wrong in this case. I personally think you need to understand what the Federal Reserve is doing, because the Federal Reserve really has in their power to choose different paths that impact everyone. If the Federal Reserve wanted to put, let's say, the US economy and potentially the global economy into a depression, they could. If they raised rates high enough, they absolutely could. Similarly, if the Federal Reserve said, hey, you know what? Our new rate of inflation that we're going to tolerate is 5%, you could have a decade ahead of much higher inflation. If they were to, let's say, start quantitative easing, say, oh, the market's, down 20, 30%, we're going to provide a level, sort of a safety level for the markets, that could create a decade of high inflation. So I think the Federal Reserve is actually incredibly important to pay attention to. And I think history supports that as well. I mean, for anyone that sort of doubts it, what I highly recommend you do is read this book, Lords of Finance. I mean, that's just captures one episode, but that clearly suggests, and I'm not going to go into detail here, but it clearly suggests that the Great Depression could have been a recession. It could have possibly even been avoided if there had been better leadership in place. Think about the millions of people impacted, the millions of businesses, the hardship that was induced. So I think watching the Federal Reserve is actually extremely important to be aware of what's going on. I mean, if the Federal Reserve overnight said, you know what, we're raising rates to 10%, I think you should expect much worse economic conditions. Now, will that happen? That's the reason why people hang on to every single word. And so let's talk about 3 different unrivaled companies that I think have huge potential over time. But the reason why, let's get back to, here it is. The stock market's dropping. You're looking at this collapse. But I'm saying, yeah, there are going to be huge returns over time, but it's going to require things that most investors don't have. What are those things that most investors don't have? One, you need to have cash for when there's actually incredible bargains. Right now, everyone keeps going, oh, buy the dip, buy the dip, buy the dip. It's like, wait a second. You keep thinking it's buy the dip and it's down 10%, it's down 15%, it's down 20% from an all-time high that was induced by ridiculous funny money, from stimmy checks to quantitative easing. I mean, it was just like last year that, less than 12 months ago that the Federal Reserve was doing quantitative easing. I mean, it's mind-blowing, like that people think, oh, we're back to normal and the Federal Reserve will be lowering rates next year and, hey, we'll be making all-time highs again soon. Unless you have the Federal Reserve sort of say, hey, we're not going to crack inflation, because right now they're closer to that path of like, hey, we are going to break stuff. We're going to break the economy. That's closer to where they're at right now versus, hey, we're going to let inflation just do its thing. We're cool. And so I think that's really important to be mindful of. So the first thing is you need to have the cash to deploy when there are crazy bargains available. I would argue we are not there. So that gets to the second and third point that most investors will not be able to do, just flat up, which is you need to have patience and you need to be disciplined for when those bargains happen. I am not trying to bottom tick the market. I'm not trying to say, oh, the S&P needs to hit this exact level for me to go all in. No, but what I am saying is I need to be able to reasonably pencil out buying stocks where I can say, hey, this has 200, 300, 500% upside potential. And if I'm not getting it, you know what? This is a tough market. I don't need to participate. I can sit and watch. And by the way, I have my, account at Interactive Brokers. There's a link below. I'm getting nearly 2% on my cash. You know what? I can sit out. I'm happy to wait because you know what? I'm going to have the patience and discipline and cash for when bargains are available. And so let's look at 3 different unrivaled companies. Charlie Munger had this great phrase, the thoughts of others were light and fleeting, of lovers meeting in luck and fame, but mine were of trouble and mine were steady, so I was ready for when trouble came. And that's exactly what I'm talking about. Be ready for when trouble comes, and you need to have the patience and discipline to prepare for it, and the cash, obviously. And so looking at Costco, Costco has an absolutely beautiful business model. They're offering goods at prices that can't be beat. Everyone wins. Customers, suppliers, employees, the shareholders. Costco deserves to win. They have this special membership model. They are unrivaled. They continue to take share each year. And yet, the stock trades at a forward earnings multiple of around 32, 35 ballpark earnings multiple for next year's earnings for a company growing maybe 10% annualized in the years ahead, maybe low teens. So you assume 5 years from now, 20 something multiple, you're really looking at break-even returns in the years ahead, maybe slightly better. At, I'm sort of penciling out most maybe 10% annualized, not that great of a return. 32 times earnings. I mean, if we're truly in an environment where the Federal Reserve is going to break the back of inflation and potentially hurt demand significantly in the economy, you're going to see that ultimately hit Costco's results as well, where people say, hey, I don't have the same income. I can't go spend the $500 at Costco, the $300, the $200 at Costco that I previously did. I'm going to have to maybe go Dollar General, or I'm going to have to not buy that huge thing of toilet paper and just buy 3 rolls, from my local dollar store. So it is a very different dynamic, in my opinion, when you're facing a tougher economy. Another example of an unrivaled company, TheTradeDesk. They're a pioneer with programmatic advertising. They have a demand-side platform with very sticky customers as they increasingly take online ad market share each year. I think I did a video even on TradeDesk over a year ago. They have a profitable and fast-growing business model. I've owned them for a while. The stock has performed extremely well since, like 2018 when I bought them. But when I look at it today, I'm saying, yeah, it's priced at 17 times forward sales. Like, even if they do crush it, even if I expect 30% annualized growth in the years ahead, at most I'm really penciling out like 100% upside. That's not crazy returns. That's not the crazy potential that I want to have. So yes, in full disclosure, I own a little bit of TradeDesk, but I'm not making it a big position. I'm watching it like a hawk. I am going to be patient and disciplined. Another example of an unrivaled company. Look at Moody's. Moody's has a duopoly on credit ratings along with S&P, as many of their clients think debt issuers are required to use their services, as bond buyers, like major endowments, have specific quality rating mandates provided by Moody's. So in other words, if you're a bond issuer, you cannot get your bond issued unless you get that stamp of approval by a Moody's, by an S&P, because there are these huge buyers that have part of their mandate saying, hey, we only buy this tranche of debt, only AAA bonds or super high quality, or we only do corporates that are, slightly below this grade. This is effectively a mandated business with required purchases, with pricing power over time. I mean, it's an incredible business. It will sort of bounce around with the cycle based on how much debt's going to get issued in any given year and how many effectively new stamps of approval they need to, hey, this bond is rated at XYZ level. But overall, over a multi-year perspective, I do not see their competitive, advantage getting disrupted. I view this once again as an unrivaled company. Here it is. This company's down. Moody's, is looking at revenue down around 10% this year, give or take, still trading around, let's say, 25 times forward earnings. And so maybe if the business is able to pick up once again, you see around 100% upside, in the next 5 years. And so I look at this and I'm thinking, a lot of these businesses, they're unrivaled. A lot of these businesses are great. And that's what I'm looking for on my personal investment journey. But what you need to do, and this is the path I'm personally following, is that, and I hope you maybe make the pledge with me, is say, hey, I am going to be patient, I am going to be disciplined, and I'm going to have that cash available, hopefully, for when there are incredible bargains ahead. We are not there yet. You are having the market crash. The Federal Reserve is saying, hey, we're going to tank the economy to break the back of inflation. That's what they've said so far. And if you don't think the Federal Reserve is important, once again, read Lords of Finance. I think I can't recommend it highly enough, just because it shows you how policymakers, leadership can drive just extreme outcomes. And so I think what we're currently facing is a downturn, and investors should be prepared. Investors need that discipline, need that patience for when the bargains are available. I just called out 3 unrivaled companies in this video, talked about Costco, TradeDesk, Moody's. They're each exceptional in their own way. They all have very different business models, very different demand structures, but they all will be touched by the economy in specific ways. And arguably, they're all still at very full valuations. Wake me up when you're able to see these companies, these exceptional companies, and you're able to pencil out 200% upside, 300% upside. When you start looking at that sort of range and you're saying, okay, my conservative scenario, my low case is 100% upside for a great company, then I'm going to be interested. When I say, oh yeah, they're hitting that low case, like super high chance that that's going to be a 1-foot hurdle. You know, Warren Buffett likes to talk about with investing. He doesn't want the 5-foot hurdles. He wants the 1-foot hurdles he can jump over. These valuations are still the 6-foot hurdles. These valuations are still sort of saying, hey, you know, hopefully it'll work out over time. Yeah, I know the economy's getting tough. I know interest rates are going higher, but hey, things will work out. That's current valuations, in my opinion. Could we get a bounce? Could that sort of stuff happen? Of course. But focusing on the fundamentals, I'm saying look for unrivaled companies. And I share the unrivaled companies that I'm personally saying, hey, at this point, I'm willing to pull the trigger. At this point, even if rates go up, maybe this company can actually even benefit from higher rates. You know, as interest rates move up, a company that has a huge cash balance, or let's say has a huge bond portfolio, will definitely benefit. My largest holding is a company with a huge short-term bond portfolio, a huge cash bond portfolio, effectively. As every time rates go up, their earnings power also goes up. I love to see it. You know, my second largest holding, I'm looking at a company that, you know, effectively sells a medical product. Okay, that's not going to get impacted if it arguably shouldn't get impacted that significantly if the Federal Reserve, you know, dramatically hurts the U.S. economy. If, you know, people say, hey, I need to keep getting this medication. So anywho, I think investors need to have the patience and discipline for what they're investing in, and to say, hey, this is the price where I can pencil out very attractive upside. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.